So steel just couldn't stay calm for long. We had been seeing several months of U.S. steel prices, as shown here in the white line. That's U.S. prices. Blue line is Europe. Orange line is China. We had been seeing a pretty distinct convergence in all three markets, and it was mostly to the downside for the last several months. Well, that story is now over, and we're now seeing domestic prices jump pretty rapidly and pretty robustly. And it doesn't look like a whole lot because of what we've been through in the last couple of years, but make no mistake, that's about $150, $200 worth of price moves just in the last couple of weeks, and we'll dive into some of the factors that are causing that. But that being said, looking at futures and basically what the market is saying or where they think prices may be going, blue line is where the U.S. hot rolled coil futures curve was as of a month ago. The green line is just 1 week ago, and the orange line is where we are today. And you can see that very quickly we've gotten into this situation where the December futures contract and the January 2024 futures contract are now right up near $1,000. And if I didn't say this, I meant to say this, but last month I probably would have said something along the lines of, I don't see any real fundamental reason why steel prices need to go to $1,000. Well, the market disagrees with me, which is totally fine when that happens. I will readily admit when I'm wrong. But I still generally stand by that idea, which is fundamentally, I wouldn't say there's much going on in the economy that would be suggestive of prices going up and staying at these price levels. That being said, I do think there is a very fundamental and somewhat straightforward way to explain how we're getting into this situation, or how we're getting into the situation that traders are expecting to happen, which would be prices continue higher by several $100s. So I think it's a combination of a couple factors. One, we've got Jeff Penns on the line, and hopefully he can corroborate this comment. But really, for the last, let's say, 3, 4, 5 months, when we go out, we as Ryerson or any of our competitors or anybody who has access to the import market, carbon sheet prices really weren't all that attractive. And not only were they not attractive, there was also the factor that domestic prices were coming down every single month we looked at the market. And anytime you're in that downward cycle of prices, as an importer, and again, I don't want to put words in Jeff's mouth, but as somebody who's contemplating making an import buy, not only does the pricing have to make sense, the lead time has to make sense as well. And if you're in a downward price cycle, if you're going to bring something in, you have to kind of have an insight of where prices are going to be, let's say 4, 5, 6 months down the line. And up until very recently, it didn't really look like a great risk reward to do something. So that's a long way of saying I think imports have been subdued over the last several months. So that's kept things a little tighter. I noted the fact that the auto production numbers actually look a little more encouraging, despite the fact that there were some rolling strikes at a number of these facilities. So that kept the demand side of the equation a little better than what I think some expected. And then you have this factor of a lot of planned maintenance that basically got brought forward. There was a fire that we had noted on a prior cup of Joe. And the maintenance outages were meaningful enough to really kind of balance out supply demand conditions, despite the fact that there was this strike going on. And I think you have this final factor, which was we started to get down into price levels. And when I say price levels ranging in, let's say, the 625 to 650 area per the CRU, where it actually probably did make some sense for either service centers or end users to go out and say, if I'm going to make a strategic buy and buy a little bit more because prices look good, that's probably around the price range where I think some end users did do that. And that helps to push out lead times, give the mills confidence that they can begin raising prices. And, leave it to the steel industry to go a little overboard with some of these themes. But because, again, do I think that all justifies a 50% price move? No, but could we see it for a short period of time? Absolutely. And we've certainly seen it in prior cycles. And whether we like it or not, it's looking a whole lot like the end of this year and going into early next year is beginning to rhyme a whole lot with last year, where we saw a large run up in steel prices, a real lack of availability. The mills got away with a lot of rounds of price hikes, and then it all kind of reversed and slowly crept out of the market over the course of the year. And you can see the futures market, at least as a snapshot as of today, is kind of saying they're predicting the same thing. Doesn't mean it's right, doesn't mean it's going to happen, but if we took a snapshot as of right now, the expectation is a very similar story to what we saw in 2023. This is just a visual evidence of what I talked about with regards to the mills taking production offline. A lot of that was related to maintenance outages. It just happened to coincidentally sync up with the auto workers strike, but give the mills credit. They did a good job of balancing supply demand conditions in the face of what could have been a pretty ugly situation for steel demand. And when I say, there isn't really a fundamental reason why steel prices need to go to 1,000, this is one of the other items I'll touch on. And we actually will touch on cost curves for aluminum and for nickel here in a few minutes. But what this is doing, I know we've looked at this in the past, the yellow line is basically your implied value or fair market value of where steel prices are. And that's just a simple math equation of taking the scrap price, so busheling scrap futures, looking over the next several months, adding $250. What's $250? That's basically the margin to which an electric arc furnace would be comfortable selling steel. It's just an approximation, but at least gives you an idea of kind of where a mill might be open or willing to sell steel. And it's a fair amount lower than where steel futures are, which is the white line. You can see we're now several $100s above where the EAFs would be able to happily make money. And again, this isn't to call out the mills for being greedy or anything like that. I think I touched on a couple of the key ways or the couple of the key reasons to how we're getting into this situation of what I'll say is temporary tightness in steel. And it could last, don't get me wrong. But from a cost perspective, there isn't really a cost support element to this equation. We've talked a lot in the last couple of months about plate prices. And what's interesting is plate is finally beginning to go the opposite direction of carbon sheet. And they're actually beginning to converge somewhat rapidly, where you have sheet prices actually experiencing this fairly robust rally. And on the flip side, almost simultaneously, you're seeing prices decrease on the plate side. And so much so that there was actually a public announcement from, I believe it was Nucor last week, for a price decrease, which for anybody who's been in the carbon space for any period of time, it's very rare for a steel mill to announce price decreases. It's very, very common for them to announce the increases. Usually it's a quiet, slow bleed lower on the decrease side. But you can see very, very evidently in the last couple of months, we have seen plate prices come back down to earth. Now, I don't want to say that the gentleman we had on from Nucor on one of our podcasts today, he was wrong. He certainly was right in saying the plate prices held up and stayed higher for a much longer period of time. One thing that was said, though, was that plate is a very different market. It's got its own structure and its own pricing. What I would point out, though, is prior to 2020, even though they are different products, even though they slightly go into different markets, there is a real historical example of plate prices and coil prices actually having a fairly strong correlation and actually syncing up fairly similarly in terms of price. It's only very recently that we saw this gap get as large or anywhere near as large as what it did in the last couple of months. And my gut kind of says that this is beginning to correct, and we'll continue to see it correct as we roll into 2024. One of the key items that I think is leading to some of the weakness is we're seeing some struggles within the wind farm sector and the wind farm industry, both in Europe and in the United States, tends to be or had been a very big driver of plate consumption for the towers. And it's looking like some of those businesses, similar to what Elizabeth said on the trucking side, some of those businesses are finding that higher rates are making it a little more difficult to operate in this environment. We are beginning to see maybe not bankruptcies, but certainly some difficult financial conditions for some of these wind farm and solar farm operators.